Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Energy Transition and Commodity Earnouts for Oil and Gas. We're pleased that you've joined us today, and before we begin, I'm going to play a short video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our slide deck and handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now that we have our housekeeping items out of the way, I will hand it over to AJ to get us started.
Hi guys, thank you so much for joining us on this webcast. We're really excited to be here. I am AJ. I'm a director in the Valuation Services group. I have close to 15 years of public accounting experience, and most of it is in valuation. I also specialize in the energy industry. Presenting with me is Adriana.
Hi, everyone. My name is Adriana Sauceda. I also work in the energy valuation group with AJ. Prior to joining Moss Adams, I worked for an energy trader and for an oilfield services company. So I'm happy to bring that experience into helping our clients with their valuation needs.
So with that, let's get started. We're going to talk a lot about earnouts in the beginning, and that's because over the years, based on our experience, we've seen earnouts not just become more commonplace, but also more complex. And a study actually validated what we're seeing in our workplace. So if you were to look up S&P's article, which was published around July of this year, they talk about how private equity is actually negotiating earnout structures in their transactions. So given that we're seeing more of this in our workplace and also the increasing complexity with these structures, we want to focus on this before getting specific to the oil and gas industry. With that, Adriana, how would you define earnout to someone that's not very familiar with this instrument?
Yeah, like you mentioned, they have become more important in transactions. But what is an earnout? In very, very simple terms, an earnout is money that the seller earns in the future, depending on certain events happening. For example, let's say I want to buy this pen, and I say, I'll pay $1 for this pen today, and if the pen still works next week, I'll pay another $1. That's an earnout. So it has a deferred payment that is contingent upon something happening in the future. Now, why would someone agree to an earnout? What's the benefit? Well, from the buyer perspective, I'm happy that I don't have to pay $2 today, right? It gives me flexibility in terms of financing, and it also mitigates the risk that I can overpay if I pay the $2 today. I can overpay for something that might not work next week. So I'm mitigating that risk that it won't perform. Now, what about the seller? What's in it for the seller to do this earnout? Well, in certain environments, there might not be any buyers out there that want to pay the $2 today. So the seller needs to decide whether to offer a discount or maybe an earnout. So for the seller, the incentive and the benefit is that they could realize a higher value that they could realize otherwise if they only get a cash payment today. We see it in our formula where the purchase price today is the $1 and the earnout, we don't know if you'll get paid, right? It's uncertain, but it's up to another $1. So our total consideration for this example of the pen will be a maximum of $2 over the time that this earnout is in place. So I think with that, we have our first poll question.
Yes, so our first polling question is, what is an earnout? And your options are A, deferred payments used in transactions, or B, money in your pocket. And the polling questions are located right on the slides that we're presenting. So if you can't see it, you can try hitting the F5 key to refresh your console. And then to respond, you're going to click the button next to the answer you choose, and then make sure you hit the submit button. This one's going pretty quickly, so we'll just leave it up another 5 seconds or so. All right, here are the results.
There's some
Good.
creativity in the responses.
Yeah, some people like the pocket money question, the pocket money answer. No worries with that. But yeah, earnout is a deferred payment, right? It's money that the seller can earn in the future. So now that we learn what an earnout is, well, what are different types of earnouts? Just like flavors of ice cream, there's flavors of earnouts. In energy, we see three main types. First, commodity earnouts, where the seller earns money when prices are high. And why is that? Well, if I'm selling oil reserves in an environment where prices are low, that doesn't sound very good to me because they can appreciate by next year. And I just wouldn't want to sell at a low price, right? I want to sell at the right price. And in that type of environment, I might go with a commodity earnout where the seller can take advantage of appreciation in the future if that happens. Second, we have operational earnouts. Those are tied to the performance of the asset. It can be volumes of production, EBITDA targets, etc. And lastly, we have geological earnouts, which are based on achieving exploration targets. We usually see these in offshore assets where the buyer agrees to pay an additional amount as long as they're able to reach a certain depth in their exploration. So let me ask you a question. What type of earnout did I use in the example of the pen? Well, I used an operational earnout because it was tied to the performance of the pen, where I pay another $1 if it still works next week. So now that we know about earnouts and type of earnouts in the industry, what about financial reporting? How do we account for these instruments? AJ, can you tell us about that?
Yeah, absolutely. We've harped enough about the earnouts. So why do accountants care about these earnouts, right? Because you need to understand if it's a liability or an equity or whatever the classification is, so you can figure out your financial reporting considerations. Typically, we're seeing it valued or considered as a liability or an equity. This classification matters because if it's an equity, you just need to value it once and you're done. If it's a liability, you're going to have to value it not just as of the transaction date, but also quarterly. You're looking at quarterly remeasurements. Now, can earnouts just be classified as a liability or an equity? No, it can also be classified as compensation and as a contingent asset. We don't have contingent asset on the slide, but I want to go into it a little in detail because we're seeing a lot of the contingent asset type earnouts in transactions of late. So how would that work, right? Usually in a liability, the buyer owes the seller based on meeting certain performance thresholds or certain thresholds. So the seller sees the upside. But what if you're buying an asset that's underperforming well below expectations? How are buyers protecting themselves, right? In this case, they can do an earnout structure in form of, let's say, a clawback or a guarantee, wherein if you're not meeting certain thresholds, whether it's EBITDA or gross profit or whatever you want it to be, you can have it in the agreement where the buyer pays you for, the seller pays you for that shortage. So this sort of clawback or guarantee is now being classified as a contingent asset. And we just want to talk about that since we're seeing that more commonly in transaction negotiations. Another thing that we want to talk about is Adriana mentioned these three distinct categories with your commodity price, operational, and geological, right? But there are overlap between these categories. For instance, let's say you have an EBITDA earnout in an upstream oil and gas industry. How are you forecasting this EBITDA? Well, you have to figure out your revenues first. So that is commodity price times volumes, right? So you can see how commodity price is sneaking into the operational earnout as well. So you want to think about how there's overlap between categories, although we have made it into three distinct categories. With that, let's understand why we're seeing more of these oil or commodity earnouts in the oil and gas industry. A lot of it has to do with the oil price volatility in the past decade, right? So if we were to look at the slide, oh, looks like we actually have a polling question. Back to you, Amy.
All right, so our second polling question is your business considering using a complex deal structure in the form of an earnout? And your options are yes or no. And while you respond, you do have the option to submit questions for the presenters in the Q&A window. We have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you. All right, here are the results.
Oh, wow, that is pretty surprising. What do you think? What do you think, Adriana?
Yeah, I mean, we have a mix of people in the audience, but yeah, I think 26% is not insignificant, right? That's quite a lot of people there.
Yeah, so maybe there is a relevance to it on why you should be negotiating earnouts in your transactions. So if we were to go back to the oil and gas industry, this slide, and take a look back on why we're seeing commodity price earnouts in the oil and gas industry. Well, from 2012 to 2014, oil was averaging around $100 a barrel. But with the discovery of shale reserves and just simple supply-demand economics, we see oil falling, starting somewhere around Q3 or Q4 of 2014, and all the way down to 2016, where we see lows of about $26 a barrel. Industry experts were expecting a recovery, maybe not back to the $100, but they were expecting some sort of recovery from the lows. But we see in 2020, because of pandemic and world shutdown, where demand for oil plummeted, storage facilities at capacity, oil actually went negative, right? This was a huge shock to the industry. And given what we're seeing with the drop from 2014 and then the oil negative pricing in 2020, the overall sentiment for the oil and gas industry was pessimistic. However, in 2022, we got another shock again where oil prices go beyond $100 a barrel. Actually, industry experts that we have talked to never foresaw oil going beyond $100 a barrel since 2016. But geopolitical factors relating to Russia-Ukraine tensions pushed this pricing beyond $100. So you can see how there's a lot of uncertainty, but which kind of makes sense why buyers and sellers are negotiating earnouts in the oil and gas industry. So if we were to take a look at a case study, This is a client that we work on where their commodity earnout is a liability, and we've just changed some of the information to make it more generic, but the structure is what we're working with in reality. So in 2020, remember, this was when the industry did not have a very positive outlook on oil and gas. The original purchase price was something buyers were just not comfortable paying. So they renegotiated the deal to be about $200 lower, with the remaining to be paid out based on an earnout meeting certain oil price thresholds. So, Adriana, back over to you. What did those thresholds look like for the seller to get an earnout?
Right. Remember we said commodity price earnout is where the seller makes money when prices are high. Well, we use something called thresholds to tell us what is considered high, depending on the transaction. So this is what those thresholds look like for this particular case study. There's a term of 4 years. In each of the years, the seller can make money where the prices are. So if the prices are higher than $50 per barrel for oil, the seller starts making money up to $20 million each year. For the gas, as long as prices are higher than $3, the seller starts making money up to $40 million each year, which gives us the maximum payment they can get each year of $60 million. And for the total term of the earnout, it will be $240 million. So it's just a simple threshold or metric that we use to tell us if the seller has earned that additional payment. Now let's look at what was the market data that we had at the time, and how did we determine, or how did the buyer and seller determine that 50 to 70 and that 3 to 4? What were they looking at the time? And like AJ mentioned, at the time of the transactions, the energy prices were super low. So that's what we see first on oil. We are sitting here at the time of the transaction. As you can see where I'm drawing with the red, this is when the transaction happened. So it's a very bad time to be selling something at low prices, right? That's what I mentioned earlier. And look at that black line. That's the futures price curve that tells us there's not a very positive outlook for oil in the future. It only goes to about $40-something in the future. So if we were just looking at that, we wouldn't think this asset's going to appreciate very much. However, the seller had probably a more optimistic view and decided to go ahead with the $50 to $70 thresholds. Now, let's look at the green line. This is the actual monthly average prices. Since the transaction, prices started to recover, and then right about here, that's where we start hitting those threshold amounts, and the seller starts getting very happy, right? Because it's going to earn money for the first year. Over here in 22, look where we are. So it's even exceeding the threshold. So the seller is getting paid for this oil commodity price earnout. In comparison, now let's look at the gas chart. Similarly, prices were low at the time of the transaction over here. But look at what has happened for the first 2 years. Is over the threshold, so sellers getting paid. But this year, everybody knows what has happened, right? Prices are low. So now we're sitting over here where the current prices are below those thresholds. So the seller is uncertain or whether or not they'll get any payment for 2023. And, that's the reality that we're in, where there's tons of volatility. Nobody could have predicted that at the time of the transaction. And that's why these earnouts are very, very useful. But now that we've seen all this market data, how do we incorporate new information that we get over time to come up with what's the value of an earnout? AJ, can you talk us through that methodology that we use? Oh, sorry, AJ, I'm not hearing you. I think. There you go.
I put myself on mute. Well, we looked at why accountants care about these earnouts, and that's because they want to know if it's a liability or an equity or whatever classification it is. Why do valuation specialists care? In this case study, this is a liability that needs to be remeasured quarterly. We're the ones that come in and remeasure it, right? So what methodology do we use? When we're looking at earnouts overall, in the past, when buyers and sellers were just testing these sort of instruments, the structures were simple. So when the payout was linear and there was no path dependency, earnouts have been valued using a scenario-based approach. When buyers and sellers started getting more sophisticated in their negotiations, and there's nonlinear payout and some path dependency, we did see Black-Scholes options value being used to value these earnouts. But remember, at the beginning of the presentation, I said earnouts are not just becoming more commonplace, but a lot more complex. That means you're looking at payouts that are nonlinear, payouts that are path dependent and spanning over multiple periods, just like we saw in this case study. In that case, the approach that you should be using is a Monte Carlo simulation, right? So we'll call it as MCS. So what is an MCS? Sounds a little bit complicated. Do I want to learn about this in the webcast? We'll make it really simple. Think about the lottery, okay? Whether you're playing Mega Millions or Powerball, you're making prediction of 5 numbers, right? To help hopefully hit that jackpot. How are you making that prediction of those 5 numbers? A lot of times the computer is generating, or the machine is generating those 5 numbers, or a lot of times it's your favorite number or something completely random, right? The math in the MCS is pretty similar to how you choose your lottery numbers. And that portion of the math is called geometric Brownian motion, or GBM, where it says there's random movement in these numbers. Of course, there are other inputs such as starting price that's going to affect your simulations, as well as volatility, which tells you how high or low the value is going to swing. But a lot of the math also has a random movement to it, similar to a lottery. So if you're thinking about a lottery, it makes the Monte Carlo simulation sound a lot more simple, right? But with a commodity price earnout, you're not just using a basic MCS, you have to add an adjustment to it called the mean reversion, right? And what the heck is that, right? When you look at the terminology, it's pretty self-explanatory, okay? So you have the MCS, which is random simulation of numbers being generated, but the mean of those simulations needs to revert to something. That's your mean reversion. In the case of commodity price earnouts, it needs to revert to the commodity price forward, because we have forward strips being traded in the market for oil and gas, right? So let's take look at an example. We ran this actual simulation where we did a MCS with the mean reversion and without the mean reversion to see the impact on results. As you can see, the first one with the mean reversion adjustment, you see these random simulation outputs, but the mean of it reverts back to the forward strip, right? Makes sense. Without the mean reversion, you're really not pegging to your forward strip, so your mean could turn out to be anything. Or rather, it's more dependent on your starting input price versus ending at where the forward strip needs to be. In this case, this is a problem when you're valuing commodity earnouts, because you are, at least in this example, largely understating your liability. There are cases where you would be overstating your liability, and you don't want that, because if you're caught, you're going to have to go through the headache of restating your financials, and that's something that you want to avoid. So for the purposes of commodity-based earnouts or industry-specific earnouts, you want to reach out to a specialist that understand the industry nuances, so you're getting the valuation done correct the first time. With that, let's see how you would report it when you're changing the value quarter to quarter as you're remeasuring it. So Adriana, what did you find? I can't hear you, Adriana.
Thank you. Now that we know about Monte Carlo simulation, let's look at the results of our case study. So I have a table here that shows us the term of the earnout, what's the remaining payout for the seller, that's what's the maximum. So this is, like we mentioned, the seller can get 60 million each year if the prices are high. So at the end of each year, there's less remaining maximum payments that the seller can earn until it gets to zero when it expires. Well, we took what AJ was mentioning. We took our forward curve. We took our volatility at each point in time, and we plugged that into our Monte Carlo simulation model. Now, what's really interesting, this in the second row is the result of the Monte Carlo simulation. I'm going to try to type it. Monte Carlo simulation. This is the result of the Monte Carlo simulation. You see at the end of the first year, when no payments have been made, is only 50 million. It's very low. And that's because if you remember in our chart, that forward curve was probably sitting still quite below those thresholds. So when we run the simulation, there's not many lottery winning happening, right? So what happens when we run it a year later, after there's a price recovery in energy? Well, the value of the earnout is a lot more. Look at this, is 100 million more. And what's very interesting is that there's less upside for the seller, but the value or the expected recovery for the seller is more. So that's something very interesting that happened particularly to this case study, just because of those big swings in prices that we talked about. So we run the Monte Carlo, we know what the earnout is worth at each point in time. But what happens to the buyer and seller financial statements? Well, we're going to talk about this 100 million that happened here. 100 million increase. The seller reports that 100 million increase into discontinued operations, and that change of 100 million goes into their comprehensive earning. The seller, unfortunately, now they're expecting to pay more. So this is going to be an increase to their liability, and the changes gets reported into their other income. So it has a very big impact to future financial statements. And now that we talk about the results of the Monte Carlo simulation, impact to financial statements, what are other implications from earnouts besides just the buyer and the seller? Well, earnouts not only impact the people involved in the transaction, but everybody else. The rest of us that are looking at this transaction, we use this transaction to maybe get a sense of what the market is paying for an asset. Like I have on the screen those hot air balloons. We want to see whether the wind is blowing, right? We want to see if maybe I should be pricing my asset higher or lower, depending on similar assets that are being sold. Well, this adds a lot of complexity when you have an earnout. I have here a table that shows that. So this is still my case study. If I don't adjust that face value of the earnout to what I think is fair value, I can use a 700 million transaction value, right? I just say, like the example of the pen. I said that pen was sold for $2, which we know by now is not true, right? It was sold for $1 plus the potential of earning something in the future. So the unadjusted example gives me a 1.4 multiple. And what happens if I adjust this? Is if I maybe could do a haircut discount, maybe a rule of thumb discount here. And I say, well, that transaction was really only valued at 500 million. Then I end up with a 1 multiple. And that's a 40% difference between unadjusting and adjusting that earnout component in a transaction. I recently went to the ASA conference where we had an investment banker talking about recent transaction in upstream. And I reached out to him and I asked him, how are you adjusting for these earnouts? Because there's tons of earnouts happening right now. And his opinion was, no, he was just using the face value of the earnouts with the assumption that all the buyers and sellers out there, they're expecting to pay the full amount. So that's kind of an extreme type of approach. And AJ, I think you've heard some different approach from somebody else, right?
Yeah, so we use the Envirus database to look at the dollar per BOE multiples. So for upstream transactions, although we are valuing using an income approach, we look at the market approach to see where our implied dollar per BOE multiple falls. So we asked the Envirus database guys, hey, you're reporting these multiples, does it include or exclude the earnout feature? And it was surprising that he said it excludes the earnout feature. Now that is a huge impact, right? Because we showed you a case study where 30% of the value is in the earnout, and the client is, or the seller is going to probably get most of the 30% of the value. But if you go to the Envirus database where it's reported, that 30% is going to be excluded from your multiples. So that's something that you want to keep into consideration as a valuation specialist when you're looking at market multiples. If your value is falling under the higher end of the range, it's probably because the market is excluding those earnout features. We just received a question from the audience, which I think is very relevant. So the question was on the mean reversion. So if we are solving to be equal to the forward strip, why should we even perform a Monte Carlo simulation? Can we just take this mean and do a earnout? Very good question. Actually, when you do a Monte Carlo simulation, you're not calculating your payout on the mean. You're calculating the payout at each simulation point. So at $25, what is my payout? That's a 0. At $130, my payout is going to be a maximum, right? And then you're going to average the outcomes. The mean of the commodity price equals the forward strip, but the mean of the outcome that you're doing at each point is not going to equal what you're seeing as the output at the end. So that's something that you want to keep in mind, and really good question on that. So with that, we're running a little bit out of time. So let's summarize this. We talked about how earnouts are helping mitigate uncertainty in value. And we're talking about this from a buyer's and seller's perspectives, because we see what risk it gives the valuation specialist just because it's excluding the earnout functions in the market approaches, right? Given the oil price commodity risk that we are seeing, we do expect the commodity earnouts to continue in the future. And it's imperative that you reach out to a specialist that understands the nuances in the industry to value these structures. So with that, let's go to the next topic. All this volatility in the ESG transition has led to, or ESG initiatives rather, has led to energy transition. And what does energy transition mean to us, right? When we presented this in Copus, the overwhelming view was people thought we were going to talk about oil and gas is out and renewable energy is in. Nothing really can be farther from the truth. And we're making a very educated guess here, because if you look at Department of Energy or International Energy Agency databases, it talks about how the current production of conventional oil and gas resources really is not enough to keep up with the demand, and they expect this to increase. I think it's supposed to increase by 6% next year to keep up with the demand. So when you have this sort of information, does it really make sense that renewable energy is going to come in and kick out oil and gas? It doesn't seem realistic or practical, right? So when we talk about energy transition, we're talking about how renewable energy or these ESG initiatives are an added resource versus a replacement to oil and gas. And we want to take this topic further because we want to look into how oil and gas is actually best positioned to lead the energy transition. If you were to look at these same websites, Department of Energy or IEA, they talk about the importance of oil and gas companies leading this transition to help us transition into cleaner fuel or reducing carbon emissions and so on and so forth. So with that, Adriana, you have some very good background in whether it's Schlumberger or Macquarie, where you have seen traditional oil and gas companies having these industry opportunities, right? Would you care to elaborate a bit on that?
Yeah, I'll talk about high-level opportunities, but we're going to do our first poll question of this segment. So stay tuned.
All right. So the third polling question is, how much capital is your business allocating towards ESG initiatives? And then your options are A, none, B, 1 to 5 million, B, 5 to 50 million, or D, greater than 50 million. And then just a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Looks like most have responded. We'll do another 5 seconds. All right, here are the results.
Yeah, so it looks like we can educate some people on the ESG initiatives and also explore people who are already investing in it to see if we can help them out as well. So Adriana.
Right, yeah. First we'll talk about high level opportunities that we can see across the industry. We identified 4 main opportunities. First, the strong balance sheet and access to capital. This is because of the big shift in the industry where in prior years we were seeing this perpetual pursuit of high growth where we would see tons of transaction, companies were very levered, and it seemed like every cycle of prices we would see a lot of companies having to restructure or shut down, and it gave the industry kind of a bad rep. But there was a big shift after COVID and that volatility that we had, where now companies have been paying their debt. There's been return to investors with dividends, and companies are in a very strong position to make strategic investments. So that really is a key thing into why traditional oil and gas, why can they make this type of investment? Well, because now they're very strongly positioned. Another opportunity that's out there is something called sustainability-linked bonds. So this is where banks offer a loan with a lower interest rate as long as the company is able to meet ESG metrics. So this is an opportunity out there that's not being really taken advantage of. And that's because companies don't want to be risking being penalized for failing the ESG metrics. And also they don't want to deal with the higher scrutiny that comes with having this type of loans. So we haven't really seen that, growing in the US recently, but it could become quite important. And lastly, the existing supply chain. Like I mentioned, in prior years, there was tons of high growth and pursuit of it in these investments. So that ended up resulting in a lot of companies having a lot of infrastructure, right? Because they spent all this money building all these assets. And now we're in a point where some companies have underutilized assets, right? And that gives the opportunity to repurpose those assets into, for example, carbon capture projects. And I want to show you some information we gather about these carbon capture projects to get an idea, because I think we all hear about it in the news, but what's been really happening? So carbon capture, historically, it hasn't been like a huge part of, green energy investment. Is that very thin line over here, this green thin line that you can barely see. So you see it's not a huge component or a huge use of investment in green energy. But we can see on this other chart I'm going to show you, both of them from the IEA, this is what is being evaluated to be invested in the future. So that's that gray shaded area that we see here. So all of this, it has the potential to grow. So this is all carbon capture projects that are being evaluated right now. So maybe not all of them will get built, but we can expect a lot of growth in carbon capture. And so this is at a high level, what's the opportunities out there. But AJ, I think you want to show us more specifically for each segment what kind of opportunities we have, right?
Yeah, if we were to look at how each oil and gas industry segment can contribute, we're looking at the three main ones: upstream, midstream, and downstream. So let's take a look at that. With upstream, IEA and Department of Energy recognizes that the oil and gas industry are pioneers in this carbon capture technology, but still they have received flack for these carbon emissions, right? How is that? Because in the past, the carbon capture has been mainly on natural resources, which is not going to help with carbon emissions. Natural resources means carbon that's trapped underground and re-injecting it into the wells to help with their economic oil well recovery, right? You don't want that. What you want is you want anthropogenic sources helping you with your carbon emissions. And that basically means you're trapping carbon emissions from the atmosphere or carbon emissions in general and re-injecting that. So when you take the CO2 and re-inject it into a well in a closed loop form, which basically means you're re-injecting it, you're getting more oil, again re-injecting it and getting more oil, so on and so forth, the circular cycle, you're creating a scenario where your operations are now carbon neutral or carbon negative. So we want to look more towards anthropogenic sources. Before, it was not very viable, economically viable, but with incentives, such as tax incentives, as well as economies of scale and more advancement in technology where you're able to recover more oil with this practice, more and more companies are starting to do this. An example would be, look at Petronova and Century facilities in Texas. They're helping with these carbon emissions through anthropogenic sources. Another interesting thing about carbon capture as well is if you look at Encana studies, one of their wells, they're able to increase the life of their well by 25 years just using this carbon capture and economic oil well recovery practice. What does that mean? That's 25 years of additional income, 130 million plus barrels of additional oil that you didn't have before because you were not using that technology, right? So suddenly, you're not just using the extra income to pay for carbon capture, but you're getting income to offset those dreaded plugging and abandonment costs. So this is where we see the technology going as it advances further, and as well as initiatives provided by the government. And if we were to look at the midstream industry, what's interesting is we've talked to specific companies who are buying underutilized pipelines and repurposing it to flow through renewable commodities. In the past, when energy transition was not a thing or there wasn't a demand for these renewable resources, underutilized pipelines would go obsolete and they would get abandoned, right? What a waste of money. Well, now, because there is a demand for these resources, midstream companies have gotten very smart and cost efficient, and they're taking existing underutilized pipelines where conventional commodities are not flowing through and repurposing it to flow through renewable natural gas and renewable commodities. This is a great cost-saving measure because the infrastructure already exists, right? You're just making some retrofits to it, like changing your pressure gauges needed for that commodity, right? You are avoiding expensive excavation costs. You're avoiding all those permits that you would need if you were doing the project from scratch. So this is where we see midstream making headway in energy transition. If we were to look at downstream, you see biofuel refineries in addition to your conventional commodities, but also clean fuel, hydrogen. We wanted to go more over this in detail, but we're running out of time. So just to look at it quickly, we have private equity clients that are currently investing in these technologies. So Adriana, quickly, biofuel is more of an EU thing, right? Can you quickly run a
Yeah, we have experience with one of our clients that invest in a project company, and what they're doing is they're building a methanol plant in the port of Amsterdam. It's one of the main transportation hubs in Europe, and this is because they have this mandate by the European Commission to reduce greenhouse emissions by 50%. So we're gonna see a lot more marine vessels, they're going to try to source their fuel from renewable sources. And they're getting ahead of that, and they decided to make this investment into developing this refinery.
Yeah, and private equity is also betting on hydrogen. And I've heard that it's mostly in the US market, because think about the driving distances in US, right? If you're in Texas, you're driving 10 hours, you're still in Texas. If you had a battery operated car, it takes a long time to charge it up, but with a hydrogen fuel commercial vehicle like trucks and whatnot, it takes the same amount to fuel your hydrogen vehicle versus your conventional gas. So this is where people are betting in the US market that it's going to be hydrogen. Toyota has built a hydrogen fuel car. And also, this is going to be relevant in aviation. Airbus has manufactured aircraft that is compatible with hydrogen fuel. So there's a lot of hype around this, and a lot of big players, multi-billion-dollar players, that are betting on this market as well. And we also talked private equity, but we're doing that on purpose because at NAPAC, Adriana, you and I were at this presentation, and there was a private equity head talking about how they're taking out money from oil and gas and rediverting it into other industries. That was a little shocking for us, just looking at where energy demand is going, or needing more conventional oil and gas based on what's on Department of Energy website. So we talked to them and also our other private equity clients just to get an understanding of why this is happening. And the response that we heard was a little bit surprising. It was not returns based. They're not pulling out because they're seeing less returns in oil and gas. They're pulling out because they're facing pressure from their board to invest in more ESG initiative based companies. So they felt like traditional oil and gas was not meeting those initiatives, and hence they're looking at other options. But here we are showing where oil and gas is actually best positioned to meet those ESG initiatives. So this is a big thing financially and operationally. You can bring private equity to invest back into your company if you're meeting these initiatives. So that's something that we wanted to talk about. Now that we've looked at financial and operational, what are the tax incentives that's out there? Quickly, we're going to look at investment tax credit and your production tax credit, right? Previously, when you're talking about credits, you're thinking about how much tax liability do you have to offset your credits. With the Inflation Reduction Act, you have something called the direct pay, where you don't need to have a federal tax liability to offset your credits. It's really just direct pay, which is a direct add to your free cash flow line. So that's something that you want to talk about. I talked about this with length with our tax experts, and they said there's a narrow purview of eligibility for direct pay. So my next question was, well, if you're not eligible for direct pay and you don't have federal income tax liability to offset against, what are your other options? There are two other options. One is you can sell these credits. It's interesting that Moss Adams actually has a group that will help you find buyers and sellers to trade these credits. And another interesting point is, let's say you're getting 10 million in credits, right? And you don't have federal tax liability to offset against, and you're not eligible for direct pay. Well, if you were to sell it on the market for, let's say, 9.5 million, typically IRS loves to tax everything, but the credit revenues that you're getting from even in a third market, you're not going to be subject to tax, which means that 9.5 million is again a direct add to your free cash flow line, which I found is very interesting. But let's say you're a company and you're making these large investments and you're expecting a lot of return in the future. So you don't want to sell these credits, but you want to apply it forward. Well, there's another option where you can carry forward these credits by 22 years or carry back by 3 years. Okay, so think of it as a net operating loss concept where you're able to carry forward and carry back. The same kind of concept is available with your credits as well. With that, we have a specific client that said, great, you have these PTC credits and ITC credits. I have a solar facility where I have gotten a PTC credit before, but now I'm looking to increase the efficiency of my facility, and I'm wondering if I'm eligible for credits again. Actually, you are, which is where the repowering 80/20 rule comes into view, wherein, let's say, just as with the client example that I had, if you have an existing facility, renewable facility, and you've already, it doesn't matter if you've had a PTC on it already, but you're expecting to make extra retrofits or upgrades to get it to today's standards, you basically need to engage a valuation specialist, right? Where they conduct a fair market value of your retained components. So what a valuation specialist does is they're going to look at your facility, do a fair market value of your retained components or your existing assets, divide it by the fair market value of your existing assets plus the retrofit costs. If that math is equal to or less than 20%, you qualify for a PTC against. This is great because you're not having to spend a lot of money breaking ground or doing things from scratch or getting a brand new facility where you're paying a premium for it being brand new. You have an existing operational facility where you've already gotten credits and you're able to get a credit on it again. So this is something that we find pretty interesting as well. And Adriana, you also, I mean, I've talked a lot about the theory, but you wanted to go through the math of the ITC and PTC. What does that look like? Mute.
Thank you. Yes. So we learned about what ITC is, what PTC is. And the Department of Energy, they haven't provided that much guidance, but they did provide this cash flow to illustrate what the benefit look like. The big thing to remember, or the key thing to remember, is ITC is based on your investment. So the government will give you back a portion of your CapEx. And that will happen here in the year one. This is what the government will give you, this 300 million, I'm assuming. So it happens very early on. It's a big sum payment based on your investment. PTC is very different because it's based on your production over time. So you will get a smaller amount over time. And how do we determine if we want to take advantage of ITC or PTC? How do we choose one or the other? Well, it's not a very simple answer to that, right? It really depends on the project. So like you mentioned, in order to take advantage of the 80/20 rule, you want to call us because we have the valuation expertise. Similar to that, if you're looking into tax credit, you also need to give us a call because we have a team of tax experts. They are very in-depth knowledge and expertise. They're helping current clients who are evaluating projects so they can help you make those types of strategic decisions. And that's from the regulatory tax credit environment. And another thing that's fueling renewable energy besides tax credits is carbon offset credits. So here I'm talking about the voluntary carbon where nobody's forcing me to do anything and the government is not getting involved in telling me what to do. Here is just simply a financial instrument that helps renewable projects get funded. So let's all imagine that we take a big sabbatical from our jobs and we move somewhere nice and we decide to just plant trees. And we're going to spend the whole year planting trees because, we want to relax. Well, how are we going to pay for the cost of planting these trees? We can create carbon offset credits. So that means we're going to give the certification companies a call and say, we have our reforestation project. We think is going to clean the air by this much. And they'll come, see our project, certify it, and they'll say, okay, you plant this many trees this year. We made some calculation. Based on our calculation, your project can generate this many carbon offset credits. So it's basically cleaning the air, taking the CO2 out of the atmosphere. And that's one type of project that could happen. Then, as we are enjoying our sabbatical, we use that money to fund our operation And we can repeat that every year. So every year, these projects around the world are generating these credits and they are helping them fund their operations. What else is out there? Well, there's also something called a futures contract based on these carbon offset credits. And this helps us kind of get an indication of what the future price of those carbon offsets will be next year. So that's very, very important because that's going to help us determine whether or not we want to invest in another type of project next year. We have 5 more minutes left, so I'll just show you what has happened in the voluntary carbon market. This is a chart from CBL, who is the biggest exchange for carbon offset credits. They trade over 90% of the volumes. And you can see the huge growth in volume traded, value traded, and number of people that are trading on these carbon offsets. One of the people involved in trading these carbon offsets is Oxy. So we've heard a lot about things that Oxy's doing. It all started back in 2021 when they did the first net zero shipment of oil. And I was lucky enough to be part of that. I was working at Macquarie, and we sold Oxy their carbon offset credits to make the whole deal carbon neutral. Since then, Oxy has developed their own type of projects where they're now generating the offsets and they don't need to buy them from a third party as much. And with that, they locked into agreements to sell those offsets to airlines, Houston Astros, Houston Texans. So a lot of different companies are buying the offsets from them, and it gives them access to another source of revenue. And the key thing also that I want to mention is there's a lot of collaboration that happens in any type of project. It's not just Oxy doing things on their own. They're doing a bunch of joint ventures with midstream companies in order to secure like the transportation of the emissions of the CO2. So there's just a lot of collaboration that needs to happen in order to pursue that green energy. And I think we have our final poll question, and we'll end up with the final comments after that.
All right, thank you. So the last polling question is, what credits and incentives are relevant to your business? And your options are A, carbon offset credits, B, repower tax credits, C, ITC, PTC tax credits, D, I'm not sure, help me figure it out, or E, not relevant. And for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. And then we're also sending them out via email tomorrow, along with a recording of this webcast. All right, we're about to close it out. Make sure you select an answer and hit submit so you can get your CPE. All right, here you go.
Yeah, so there are a good mix of answers here. The ones that said, help me figure it out, reach out to us. We're happy to help you. And of course, the other credits as well, we're happy to help you with that as well. So with that, let's take a look at what we talked about, right? To summarize, we're talking about how traditional oil and gas companies are best positioned to lead this energy transition. We're talking about specific skills, whether it's building pipelines or carbon capture, and also getting private equity back to invest in these initiatives or invest in oil and gas. Adriana talked about carbon capture more in detail and carbon credits. And also we talked about the tax incentives that's out there. A takeaway that we have for smaller oil and gas companies is at COPIS, we heard this comment that this looks like something that would benefit the larger companies because they have resources, but like Adriana mentioned, the smaller companies are contributing through JV or joint ventures, and we are seeing them make a return off of this. So come talk to us about that as well. For all oil and gas companies in general, the takeaway is when you're looking to hire consultants, make sure it's a full service firm, because these are not issues that you can look at in a vacuum. It's not just a valuation issue. It's not just a tax issue or an accounting issue. You get the point, right? Like, these are different service lines that are having to work with each other and collaborate to figure out the best return or return for you, you know. So you want to, and it's not your job to figure out which service lines are relevant. It's our job as consultants to know who to pull into a project to figure out how much credits we can get you or what other benefits are there that's available to you. So think about that as well. With that, Adriana, I really want to thank you because you helped put a lot of this content together, all the research together. Huge thanks to our marketing team that made this a success. And with that, thank you guys. We hope to hear from you. I hope this presentation has been as fun as it has been for us. And Amy, we'll hand this off to you now.
All right. Thank you both for a really great presentation today. I do wish we had more time. To our audience, if you have further questions or comments, please reach out to us and we'd be happy to continue the conversation. You can drop a note in the Q&A window or reach out to AJ and Adriana directly. Their contact information is in your console as well as in the slide deck. We also invite you to register for our September 12th webcast, which is Navigate Change and Regulatory Accounting for Our Utilities. A link to register is in the upper right-hand corner of your console. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks if you have difficulty downloading it now. And then finally, here's a link to a survey for today's presentation. Your feedback is appreciated, and thank you for joining us. Take care, everyone.